All right, we're going to run through the rest of this lecture in looking at chapter 16. And we left off looking at the three theories of capital structure and how that plays a role. But we also have the idea of agency problems. So if you think back to corporate finance, talking about corporate governance and the idea of agency issues, right? One of the issues that we have in the capital structure section relates to decisions that managers make that are done to that do not maximize the value of the firm, right? So decisions that are non-value maximizing purposes. Okay, and there's many reasons why managers can use corporate funds for non-value maximizing funds. Self-interest, right? Country club memberships, we've talked about that, but also like not taking risk, right? A manager says, I don't want to do this project because I'm worried about losing my job or something of that nature. Well, here, when we look at agency problems, they should undertake a project, any project, that the ROIC exceeds the weighted average cost of capital. Okay, and by not doing so, that is not maximizing the value of a firm. A second is the idea of underinvestment, and that comes along with the same point. Managers may avoid risky projects even if they have a positive net present value because they don't want to take on the risks that come with that. They want to stay entrenched in their job. They want to minimize the amount of risk that they have. So that's where we see agency problems coming into play with capital structure in managers making decisions that don't maximize the value of the firm. So what is the value of the firm, right? Well, the calculation here is as simple as free cash flow divided by the cost of equity. Okay, so if we have here a company with 100 in EBIT and a tax rate of 25% and a 16% cost of equity, what is its value? Now, it doesn't explicitly say this, but we're looking at this company in terms of 100% equity based. So the next slide is going to have the answer. See if you can take free cash flow. Right now, free cash flow is basically EBIT minus our taxes, right? Divided by our cost of equity. Right, so we've got 100 times 1 minus t divided by 0.16, and we get a value of the firm of $468.75. So now we have that same company, but we factor in debt here. Okay, we add an 8% interest cost component to it. So we looked at the last slide, value of the firm without any debt was $468.75. Now what happens if we add 500 in debt? Okay, so if we're looking at adding debt, how does that impact the value of a firm? Okay, the value of the firm here is the value of the unlevered firm plus the tax shield, right? So we've got the 468.75 plus 10. Well, why 10? We have 500 in debt, interest of 8%, so 8% of 500, okay, which is 40 times our tax rate, and this 10 is what we consider our tax shield. Okay, so now the value of this particular firm is the value of the unlevered firm plus our tax shield. So how does our leverage and our change in leverage, how much leverage we have, or debt versus equity, impact our weighted average cost of capital? Okay, so we have this firm, beta of 1, risk-free rate of 6%, market risk premium of 6%. What is the cost of its equity? Well, I think you can figure that out pretty simply. Our cost of equity is 12%. Okay. Well, now what happens if we look at adding debt, right? So here's the equation or the answer, pretty straightforward. Now, when thinking about debt and changes in our capital structure, we started with a company that had 100% equity, no debt. Now, it would be natural to assume that as a company adds more debt, it's going to cost them a higher interest rate, right? The risks increase. We talked about bankruptcy costs. The risks of adding more debt as it becomes a more and more leveraged company is going to cause the interest rates to rise. We're going to pay a higher and higher interest rate. So here we're looking at an example. If the company recapitalizes, which means takes equity and turns it into debt, right, as part of their capital structure, it's going to use debt to purchase the stock, pull it out of the market. If it has a weight of debt, a percentage of debt of 20%, our interest rate is 8%. And if we shift all the way to 50% debt, it's going to raise our interest rate to 12. Well, how then does that kind of come into play? Okay, as a company adds more debt or becomes leveraged, it increases the amount of debt, or excuse me, increases the beta, right? The more debt a company has, the more risk inherent in the business and the more systematic risk it would entail. So this is a key formula here that looks pretty confusing. It's saying that the beta of a leveraged firm, a beta of the firm with debt, is equal to the beta of the firm when it has no debt, okay, times 1 plus 1 minus the tax rate, times the percentage of the capital structure that's debt divided by the percentage of the capital structure that's equity. All right, so weight of debt divided by weight of stock. Okay, so let's work through a scenario. We have cost of equity with debt of 20%. So the company has 20% debt. What is its then cost of equity? So the Hamada's leveraged beta is saying that as a company adds leverage, it's going to change the risk profile of its equity of the stock, and it's going to change the cost of a stock. And so as we make changes in debt, it has a direct impact on the cost of equity as well. They're related, they're interconnected. Okay, so see if you can solve this. We have a weight of debt of 20%, weight of stock then of 80%. And our beta unlevered was 1. Okay, our unlevered beta, B subscript U is 1. See if you can solve this. So quick pause the video, look at the formula, plug the numbers in, and see if you can get that. So we got to find the levered beta first, and then plug that new levered beta into the CAPM formula. So go ahead and pause. All right, so let's see if you got the answer. We put 1 in for our unlevered, times 1 plus 0.75 times 20% divided by 80%, and we find a levered beta of 1.188. Now if I plug that 1.188 into our CAPM formula, I find that the new cost of equity is 13.13%, up from the 12% that we originally had at the beginning. Okay, so now then what is the company's weighted average cost of capital? Okay, we have 80% equity at a 13.13% cost of equity. We have our debt pre-tax at 8%, back from that previous slide. Okay, using that information, what is our weighted average cost of capital? Okay, so pause the video, see if you can calculate what the weighted average cost of capital is in this situation. All right, when I plug in our weight of debt, 0.2 times 1 minus 0.25, right, 1 minus our tax rate, times our cost of debt of 8%, plus 0.8 times 13.13%, we get a weighted average cost of capital of 11.7. So I hope you were able to get that particular answer. Okay, the last thing that I'm going to show you here is a company wants to find the optimal structure, right? And the optimal structure is one that maximizes the value of the firm, which essentially is the one that has the lowest weighted average cost of capital. So here we have 0% debt, 20% debt, 30% debt, 40% debt, 50% debt, right? And our interest rate fluctuates between 0 and 12%. But as we add more debt, it changes the cost of our equity as well, right? And when we combine those two figures together, we get our weighted average cost of capital. So here in the R of S, we're finding our new levered beta and plugging that into the CAPM formula. We did that here for 20%. Okay, and if I plugged in the numbers, built the table, built a data table to do all of this, I find that the lowest cost of capital is at a 30% debt perspective. So that leads me to believe or to find that the best capital structure for this particular company is 30% debt, 70% equity. Okay, so I hope that this helps as you work through the homework for this week and you work through the problem set, the practice set. I've got the PDF attached to this page that will help with that. And please let me know if you have any questions. Have a great spring break.